Hey everybody, it's Chris with Life 180, and one of the things that I am hearing a lot about right now is Index Universal Life. Now, I just did a video on exposing Doug Andrew. I've got more videos coming out on that, but in all of my conversations with people on the internet, on YouTube, on Facebook, on Instagram, about the different strategies when it comes to leveraging whole life or Index Universal Life, I basically, what's been happening is I've been hearing a lot of lies about Index Universal Life. There are a lot of people out there who are selling Index Universal Life that A, either don't understand what they're selling, or B, are educated improperly and utilizing the wrong information to actually sell Index Universal Life as something that it's actually not designed to be. And so, you know, if you don't understand my background, I used to be the head of business development for one of the top Index Universal Life carriers in the country, right? And with that, I got out of it because of my conversations with the people who design the product, and because of my conversations with, you know, people on the corporate team, and because of my understanding about what the purpose of an Index Universal Life policy is from the insurance company side of things. Now, I know what the marketing is and how it looks really fantastic on the consumer side, and it can look fantastic and sexy and better returns and better performance and upside potential and downside protection and, you know, guaranteed income for life when you hit retirement and all these different things. But what I'm going to cover in this video is the fact that there are four major things. There's a lot of things, but there are four main key things that I think Index Universal Life is being misrepresented as during the sales process. And I want to make you very aware of those in this video. So let's go. So the first lie that I think most Index Universal Life agents are telling people, consumers, the people that are buying the product, is that the guaranteed column doesn't matter. And here's why. What they say is that you have the guaranteed column and the illustrated column. The illustrated column typically is based on an illustration rate of, let's say, 6.5%, 6.4%, something of that nature. I've seen people running illustrations at 6.4% and running big organizations like the MPI stuff that Curtis Ray is doing, and it's just all just garbage, honestly. What they tell you is that you have the upside potential and the downside protection. And the thing is, if the market does really well, you can get maybe 13%. If the market does really horribly and loses 20%, you're protected at 0. And so what they say is, over a long period of time, it'll all average out. And so therefore, the market's never had negative years for a long period of time. So therefore, the guaranteed column will never come into play, so you don't have to worry about it. That's what they tell you. But here's the deal. The guaranteed column has way more to do, it has to do with a lot more than just the performance in the market, whether it's the Russell 2000 or the S&P 500 or Dow Jones, depending on the company that you're going with, and the indexing methodology that you choose in the policy, inside of the policy. It has a lot more to do, the guaranteed column has a lot more to do with internal fees and expenses than it does the actual performance in the market. That's the part that people overlook deeply. And here's the thing. When I was at my Fortune 1000 job and I was talking to the policy designers, the thing that I learned the most about why life insurance companies are making Index Universal Life, because the company I worked with was a whole life insurance company for 150 years that had pivoted to becoming an Index Universal Life company. And so now they're one of the top Index Universal Life companies in the country, even to this day. But here's the deal. Why did they go that direction? If they were doing whole life and whole life is so awesome, why would a company like that go an Index Universal Life route? Because it shifts the responsibility, the guarantees, from the insurance company to the actual insured, right? And so when you shift the responsibility from the insurance company to the insured, what does that mean? It means the guarantees don't have to be there, right? So it takes the insurance company off the hook, but it's a profit center. It's a bigger profit center. There is more profit in the insurance company, for the insurance company, than there is with whole life, with Index Universal Life. There absolutely is, and they're protected. Think about it this way. A good Index Universal Life policy, if you get a good contract, let's say, and I know some of you that are watching this are going to be insurance agents, and some of you are going to be consumers who are looking to make a decision around, should I buy an Index Universal Life policy or should I buy a whole life policy? But here's the thing. In Index Universal Life, if you're a good agent, will pay a compensation rate of up to 140, 150%, maybe even 160% if you're like a super big producer. That's on the contract, apples to apples. A whole life policy, if you go according to New York regulations, will pay you at about 99% at the top end of the contract. There are a couple companies that will get you up into the 120 range, in that range for a really good producer. But once again, that's about 20 to 30% more that life insurance agents make for selling index universal life over whole life insurance. So think about it, like, let's just use logic here. How can a life insurance company create a product that gives you, the insured, more upside, downside protection, give you the same opportunity of guarantees and all these different things, and be able to pay the insurance agent more money? It just doesn't make sense. If you believe that sales pitch, that if you believe that makes sense, well, I've got a bridge in Brooklyn I can sell you, because it just doesn't, it doesn't make any logical sense whatsoever. So just know that is a big issue that I have, is that the guaranteed column on the index universal life illustration really is the guaranteed column, taking into consideration the fact that that your administration costs inside of your policy can be raised, your insurance costs can be increased, that the market can perform poorly, and it's taking all those things into consideration. And it's taking all the variables that you don't even understand, that your life insurance agent won't even fully understand. So the biggest issue that I have is they say, don't even worry about the guaranteed column. It's not gonna worry. It hasn't happened forever. This company's been around for 150 years and they've never had to do that. Well, guess what? That's a BS story as well, because even if the company I was with has been around since 1852, right? But guess what? They've only been doing index universal life since the late 90s. And so it's been like 20 something years, like in the low 20s of, as far as a couple decades that they've been doing this. And the market has been awesome during that time. We've had a couple blips for a couple years, but right now we're coming off a big bull market run. I think a lot of people are concerned about where the economy is going. And so I think more importantly, companies that have a lot of guarantees that they have to back up, it's important to understand that when a life insurance company has investments in their general account and they have guaranteed products that they have to back up, what are they going to do to back those products up if they can't get the returns in the market, in the fixed income markets, which if interest rates remain at all-time lows, which they're looking like they're going to do, they have to create other profit centers. Other profit centers are term life insurance, index universal life insurance policyholders. They're going to increase insurance costs, increase admin fees, and all this stuff around all of the other areas to make up for the lack of return in other investments in their general account. They're going to have to create that profit center. So the people who are buying index universal life policies right now are ultimately, in my opinion, going to be penalized to actually back up and meet the guarantees of the people with whole life policies if that company has both. So the second lie, I would say, is not so much a lie, I guess, as it is just a misleading element. It's having the conversations around the actual assumptions in the illustrated column, in the current column, that where they run it at 6.4% and they show these beautiful this beautiful compounding growth and this always be compounding concept, which is just garbage because it doesn't work that way. The only guarantee that I will tell you about that column is it will never perform like you see it. The only guarantee on an index universal life illustration is that you will never see the numbers year after year after year match up. Once you get through year one, no matter what happens, it's never going to align. It's just not going to. And so you don't have the clarity, and it's really hard to plan for something that you don't have clarity around about how much money is going to be there. And so that's to me, I think it's a really big issue, because I think people oversell on that column and the growth and the opportunity and the cash flow, because the challenge is it typically performs far less and it never meets those illustrated expectations. Trust me, I've gone through hundreds of these policies personally. I've met with hundreds of people personally who had these policies and then they blew up in their face. And I just did a video on exposing Doug Andrew on this last week. And in that video alone, he's involved in a class action lawsuit right now where 66,000 people that are clients of his that bought Index Universal Life, that structured with him, and he says he's one of the best in the world at doing this, one of the only people that could do it the way he says you can do it. 66,000 people are suing him. And if you haven't seen that video, you need to go back and watch the details of that, because it just goes to show you these things never perform what they are illustrated to look like to perform as. They look really good on paper, but they never perform at that rate. And so you need to make sure that you have clear expectation that you cannot rely on this always be compounding concept that you're never going to have down years. And when you have a down year, the problem is if you have 6.4% average, if you have a down year, yeah, you have a 0 in there, and so you have downside protection on the investment. But guess what? You still have the admin fees, you still have the insurance costs. So it's not actually a 0. You still, the insurance costs and the admin fees are going to eat into the capital that you have going on right there. Plus, in down markets, if the insurance company needs to increase and generate more revenue for the company, they're going to increase your admin and insurance costs. And it's going to happen. I mean, it's just a matter of time. And if you think taxes are going up, if you think that that interest rates are going to stay low, then this is just a matter of time. And you need to understand all the moving parts, all the functions inside of these policies, and realizing that the only guarantee in this illustration that you're looking at, if you're going through the process of buying an IUL policy, the only guarantee in it is the fact that the illustration will not be accurate. All right, so the third lie that I find most agents use involves the guaranteed income for life component of an index universal life policy. Now, here's the thing. Most index universal life policies at this point in time have some component to them available called a LIBOR, or lifetime income benefit rider. And what that does is most agents, and I know some of these companies, some of these guys that are hawking this stuff out there, will go out and tell you that, hey, your money can grow. And then once you get to retirement age, you can trigger this and it will guarantee a crazy amount of income for the rest of your life. But here's the problem. That lifetime income benefit rider only exists based on that illustration amount. So a lot of times it'll show you accumulating money, and that rider will show 10+% annualized return, which if you could do that, it would be absolutely amazing and insane. But the bottom line is it doesn't work that way, because it's 100% based on the amount of money that you have in your policy once you hit retirement age. And the only way that the lifetime income benefit riders, some companies call them different, but you get the point of the principle of what the rider is and the effect of that rider has on your policy and on your retirement income. What that does is it only comes into play based on the amount of money you have in your policy when you retire. So therefore, if your policy has challenges beforehand or blows up or doesn't perform the way it's illustrated at, which by the way, it won't, I pretty much guarantee it, then you're gonna have issues. Listen, once again, Doug Andrews, 66,000 people who are suing him over this. There's other people out there, Curtis Ray, who's gonna get busted doing the same exact stuff, because their assumptions and the way they're selling this is not designed, like the product is not designed to do what they're saying it's going to do for you. And it's great marketing. And if you didn't know, if I didn't know what I know, I would buy into it 100%. Like it makes sense. It's great marketing. On the surface, it looks great if you don't have the whole story, and if you're just kind of going on, ooh, look at the market, look at the returns, look at all these different things. To me, it's crazy that they're not taking into consideration the variables, and they're just blowing past the guaranteed column of this thing. And it's disgusting. I'm hearing people, I'm having conversations with people. You can imagine, I'm putting out these videos now exposing Index Universal Life. I'm having people call me every single day telling me about their policies and the problems that they're having. And the craziest part about that is these insurance companies, you know, people are trying to get their policies reimbursed. They're trying to get their money back for doing these things after 2-3 years. And the insurance companies are saying, no, it's good insurance. It's insurance. It's insurance. And the problem is, if you don't structure them properly and you're not working with somebody that really understands all the moving parts, then you are going to be stuck with this. You're going to get 2-3 years down the road. You're going to have your money into these policies. It's not going to perform the way that you think it's going to based on how you were sold. And therefore, then you're going to go back to the insurance company and ask for money back, or you're going to ask for something to happen. And they're going to basically say, listen, I'm sorry, you purchased an insurance product. It's not designed to do that. And you're going to be kind of holding the bag on that one. And I know it because I've been talking to people who are going through that. So I just really encourage you to be careful about that. And that leads me into my fourth lie. Now, the fourth lie is that Index Universal Life is a more capable, more beneficial, more efficient, more effective product to use for infinite banking. Now, I don't call it infinite banking because I think there's some math behind infinite banking that just doesn't make a lot of sense, or it's not telling the whole story once again. That's why we utilize a strategy we call the AND asset, which is essentially infinite banking, utilizing whole life insurance instead of utilizing an Index Universal Life policy. Now, once again, this is just great marketing on behalf of the Index Universal Life agents out there. Mind you, these Index Universal Life agents, think about it this way, they can sell both. They could sell whole life or they could sell IUL. But the bottom line is they're selling Index Universal Life, I believe, because the commissions are higher, period. Like, that's it. Or I'll say this, maybe they're selling Index Universal Life because they drank the Kool-Aid. They believe what they've been sold. But I promise you, if you look into the math, if you look into the actual internal fees, the ability for the insurance company to change your expenses inside of the policy every year as you get older, as insurance costs go up. Think about it this way. Every year, your Index Universal Life policy insurance charges get more expensive as you get older. It's just baked in. That's the way they function. The way that the Index Universal Life products offset that is they're supposed to be more cash accumulation in the policy, so it will absorb the increase in that cost. The problem is when the policy doesn't perform as illustrated and you get older and the insurance costs go up naturally anyway, and then you add on top of that where the insurance company can create a compounding problem to that increase in cost anyway, and they say, listen, we're also going to increase the actual rates of your insurance charges, so that compounds the issue, so your insurance expense gets way higher, and therefore now your insurance policy just blows up and you have a big problem and you don't have the money and you don't have the retirement income that you were banking on, and it's all garbage. And so once again, I would say for the context of this lie about Index Universal Life not being a great banking alternative, the way they do that is they say to you all the benefits that it has, and I'll do probably another video on this too, because it's going to be a much longer topic, but the bottom line is that your insurance policy should not be an investment. If anybody is selling you life insurance as an investment, they're selling you wrong. You're buying something that is not accurate. Like the life insurance is life insurance. Now, life insurance companies from financial institution perspectives are super secure, they're fortresses of wealth, and they really, I believe a properly structured life insurance policy should be a foundational component to everybody's financial plan. I'm a big believer that a properly structured whole life insurance policy is the only way to make sure what you want to happen will happen when you want it to happen, whether or not you're here to see it, right? So like that component of it can be a great way to save in your rainy day fund, a great way to save for an opportunity fund, a great way to save if you want to be able to invest in crypto or stocks, or you want to buy real estate with it or something else. But the bottom line is this: if you know that you want to invest in day trading, if that's your deal, if you want to do real estate, if you want to do crypto, if you want to invest in a business, if you want to buy and flip cars, I don't care what it is for you. The bottom line is those channels are where you need to be taking your risk and getting your returns. I'm a big believer. You have to take risk if you want to create wealth. You have to. You should not create risk inside of your insurance policy. And the more variables you take on, the more risk you take on. I think it's important to understand that. And so when you leverage your Index Universal Life policy from a banking perspective, it just compounds the issue. A whole life insurance policy is better for that, because what you're doing is you're guaranteeing, you're putting your money into an account where the funds are 100% guaranteed. It's very predictable. You know what you're dealing with, and so you can operate. If you can't manage anything that you don't understand the metrics for. It's impossible to manage the metrics of an IUL on a year-to-year basis, whereas in a whole life insurance policy, you know what's going to happen. So from a banking perspective, never, never, never use IUL. I mean, Nelson Nash, the guy who created the concept in general and started the whole process, would be rolling over in his grave seeing all the people who have tried to bastardize the concept and use it use a strategy with an index universal life, because it just doesn't work. Do not believe all the people who are telling you that it does. So anyway, I hope that makes sense. I hope it helps. If it's your first time here and you found value in this, by all means, please hit that like button. It definitely helps the channel out. Hit the subscribe button. Make sure you click the bell. That way you get notified every single time I launch a new video. I really am enjoying creating this content. If you have any questions, go ahead and comment below. You'll know if you comment, I engage with as many comments as I can, almost 100%. If you have any questions, you want another video, let me know. I will create it. If you are an agent, if you are somebody who's looking to, possibly leverage life insurance in your financial world, definitely subscribe, because I've got a lot of content coming around this topic that, whether you're an agent or a consumer, it's going to benefit you. So anyway, go out there, have a blessed, inspirational day, and I look forward to seeing you soon. Take care.